Welcome to Finance with Avrin. In this video, I want to give you a detailed overview of three major dividend paying stocks that are Dividend Kings. And if you own all three of these, you will be getting paid a dividend every month. I'm going to let you know what a Dividend King is, what sets that apart from other dividend paying stocks, what sets these companies specifically apart from other stocks, how long they've been growing their dividend, information about their dividend payout ratio, is it safe, what the dividend amounts are, and also just some overview and details about the company itself. And let's just get into it right here. So yeah, before we jump into these three specific stocks, let me tell you about what a Dividend King is and why it's such a great thing to be in this realm of stocks of Dividend Kings. There's not many of them. There's around 50 companies that are Dividend Kings, and there are like hundreds upon hundreds, publicly traded companies. Obviously, the S&P 500 has 500 companies, and there's even way more than that are publicly traded stocks. So Dividend Kings are companies that have increased their dividends for at least 50 consecutive years. Yeah, so that means they've grown their dividend by some amount, as long as it goes up at least once per year, basically. They've done this for 50 years in a row at least, and that's how they become Dividend Kings. It's not an easy feat. It's not something that obviously a lot of companies can do, because typically when a company raises its dividend, that's them saying and also knowing and also showing that, hey, our financials are doing well enough that we can increase this dividend, pay out more of a dividend, and we can sustain that. And, we can just keep doing that basically, because all these companies pay a dividend every quarter. So they're paying this every quarter, basically 4 times a year. So when a company raises that dividend, they're basically saying, we can afford this. Our financials are doing well. And also our future guidance, we predict that we're going to be doing well, the next year, because that's ongoing. They're not just paying it like one time. There are special dividends that some companies do, like a one-time special dividend, but these Dividend Kings have been increasing their dividend for at least 50 years. So that's awesome. That's saying a lot right there. And that's not saying like these companies do well every quarter or every year or anything like that. There's definitely times where these companies have been, had some rough moments for sure, whether it's microeconomic or macroeconomics, things that they can't really control, they're out of their control, or also things that they can control that they just haven't done a good job of. So yeah, these companies aren't perfect. That's definitely not, saying that they're perfect to get in this list of companies, but they are setting apart themselves from other companies for sure. And this is not financial advice. I'm not saying go run and buy these 3 stocks. Personally, I only own one of these 3 stocks. I'll let you know which one that is. And I'm thinking about buying in the other one as well. However, these are all consumer goods companies. So that's the sector that these companies are in this video right here. And I'm kind of a little bit heavy on consumer goods right now. And so I'm not really like rushing to buy other consumer goods. However, if I were, these are 3 companies, or the other 2 that I don't own would be ones that I would definitely consider. Also, in this environment that we're in economically, consumer goods stocks could continue going down because, there's the recession looms are still overhanging in the market and everything. And, the high interest rates, the federal funds rate. So there are definitely reasons why these companies could keep going down. I'm gonna show you the charts of where they've been doing this year. And yeah, they're all pretty much down for this year. So this could be a good entry point to start your position in the stock, maybe add to your position in the stock, or maybe it's a good time to just keep it on your radar closer to watch further to see how it's going to go on with these stocks. But yeah, so that is a Dividend King. And before you become a Dividend King, you can be a dividend aristocrat. So there's more, of course, companies that are in that realm because, that's less years. So a dividend aristocrat is a dividend raised for 25 consecutive years. So before you become a Dividend King, you've got to be a dividend aristocrat. So these companies that I'm going to talk about have all been, dividend aristocrats. They passed that, over 25 years ago. So yeah, without further ado, let's jump into these 3 companies I'm going to talk about and the payout dates and everything like that. The first company I want to talk about is Sysco. So yeah, there is a highly likely chance that Sysco has touched your life in some way. Now, you might not know them like as a brand. Some of you might, oh, Sysco, I've seen those trucks on the highway or something like that. Some of you are like, what is Sysco? Is that something food? I think I seen that when I was in school. Yeah. So Sysco is the largest food distributor in the United States. They supply all kind of different companies, hospitals, schools, restaurants, just fast food chains. They supply a lot of places with a lot of food. They are somewhat in a moat. And I like companies that are in a moat that kind of control like a lot of operations. They have, they have pricing power. They can, shift things. They can pretty much control a lot of things because they're so huge. They're so major. They have so much market share. And Sysco is one of those companies. They actually tried to become even bigger. They tried to buy U.S. Foods in 2015, which was the second largest food supplier in the United States. So that merger ended up not happening because the Federal Trade Commission pretty much placed an injunction over the deal concerning that it would affect the market. 2 huge companies, one and number 2, of a certain sector combining. People could have both sides of that. They could say why they don't like that, why they could like that. So, but basically that did not happen. So Sysco tried to become even bigger. They could not. And so they end up having to pay that $300 million breakup fee. That's what happens a lot of times when these mergers, when a company wants to buy another one, they have like a clause like in the contract they're saying, hey, if this doesn't go through, whether if we pull out or if it doesn't get approved, we'll pay you this much, basically. So that's what they had to pay. So Sysco, like I was saying, tried to become even bigger, but they supply a lot of companies. They're still huge. They're still number one food distributor in the United States. They supply on the grocery side, let's see, Whole Foods, Kroger, Target, and then also in the restaurant space, Chipotle, Darden Restaurants, Yum Brands, and that's several, companies, Taco Bell, KFC that are underneath Darden Restaurants and Yum Brands. That was Yum Brands specifically right there. But so, and also SeaWorld, it says. So they supply a lot of different sectors. You got, of course, restaurants, healthcare, education, government, travel, leisure, retail, and other customers hold nearly equal weight to one another. So they are spread out right there for sure. Sysco was founded in 1969 in Houston, Texas, and serves over 600,000 locations with food delivery, like I was stating, with restaurants, hospitals, schools, hotels, and other facilities. So they are major. They're stating, I've seen a couple different articles and stated two different numbers, but their market share of total food delivery in the United States is around 16 to 17%. So I've seen that number, both of those numbers on different articles. So that is their amount, according to the company, around 16, 17% of total food delivery in the United States is handled by Sysco. So yeah, that's some information on Sysco. Let's jump into some information about this dividend though. With Sysco's dividend, if you own this company, their payout dates have been typically these months: January, April, July, and October. So if you own this company, that is when you would expect to receive a dividend from this company. Typically it's around the same date. If you see the dividend history, around the 21st, 28th, 22nd of those months, but those are the months that you would be getting paid if you held this stock right here. Sometimes you'll see the wrong years as far as dividend growth. Dividend growth for Sysco, they have had consecutive dividend increases for 55 years. So yeah, they're over that 50-year threshold to become a dividend king. And with Sysco's dividend, currently their dividend yield is around 3.08%. And of course, that changes depending on the stock price and also the payout amount of the dividend. So their dividend yield currently is around 3.08%. which is an annual payout of $2 per share, which means quarterly is going to be 50 cents per share. Their payout ratio is around 49.13%, which is a nice payout ratio. That's showing that they could sustain this dividend. You want to see lower payout ratios. You don't want to see, close to 100 or, over sometimes over 50s, kind of depending on things. You want to look at the cash flow payout ratio, see how much of their cash flow they're paying out for their dividend as well. Because there's a couple different payout ratios you can look at, a couple different ways to determine what the payout is for a stock in a company on their dividend, according to the cash flows. So you want to check that out. So the payout ratio for Sysco is around 49.13%, which is nice. Not something I'm really that concerned about looking at that. Their 5-year growth rate on their dividend is 6.58%. And we're going to look a little bit more into that, but their dividend dates right here. So recently they declared their dividend back in August 24th of 2023 with an ex-dividend date of October 5th, 2023. And a record date of October 6, 2023, and a payout date of October 27, 2023. So we are past that ex-dividend date. So right now, if you bought the stock, if you didn't have a position in it, you would not be getting paid on that October 27, 2023, because you have had to own the stock before October 5th, 2023. You have to be on record before that ex-dividend day. So with this current dividend that's upcoming, you wouldn't get paid that unless you already owned the stock before that October 5th, 2023. However, if you bought the stock after that, you would be eligible for that next dividend, which would put them at, I believe there's next one is going to be, January, because that's their pretty much historical payout date. It's going to be January, April, July, and October. So they're about to pay the October dividend, and their next one typically would be in January. And so with their CAGR, their other dividend growth rates, that 5-year, that 6.58%, their 10-year dividend growth rate is around 5.86%, 3-year dividend growth rate at 3.23%. So not a substantial, really large dividend growth rate, not a small one either. It's kind of like okay, your dividend's growing. With dividend stocks, you want to see a nice dividend growth rate, but also it's nice to have, price appreciation of the actual share price itself. Because when you buy dividend stocks, some people buy them just for the dividends, and that's understandable. Some people buy them for the dividends, the dividend growth, the growth of the stock price, the capital appreciation, everything like that. So it's nice to have a combination of that in your portfolio, whether you have some stocks that are just like, these are safe dividend stocks, or these are dividend growth stocks, or these are dividend growth stocks with potential for some nice growth on their stock price. So that is something to look at as well with Sysco and their stock. Of course, down for the year to date, Sysco stock it's down around 15% right there. Is a lot of stocks are in this market. There's several stocks. There's some stocks that have been holding up this market, and they're not on this list. The Magnificent Seven, as you want to call them. The Nvidias, the Meta, the Google, Alphabet, Amazon, Apple, all those. Those companies right there, Magnificent Seven. They are what kind of pretty much held up the market this year. Now, some of them are kind of looking a little, but so a lot of other stocks haven't done that well this year. And Sysco is one of them. They're currently under their 200-day and 50-day moving average. So for the year, see them down around 15.91%. Even for 3 years, almost flat right there. You see, they've had some ups and downs for sure. And they're kind of making a trend on their chart. We could see some lower highs and some lower lows. So you could draw some lines for sure, not the 200-day and 50-day. Let me get those off because that's not the lines I'm talking about. So you see how the highs of the stock kind of been trending down and the lows of the stocks have been trending down as well. So it's something to just kind of look at. Like I'm saying, this isn't financial advice to, hey, this is to jump into company now or anything like that. But that's just something I noticed just briefly looking at the chart. And so for the 5 year, down around 7% as well. They got hit by the COVID pandemic, like a lot of stocks did. They recovered pretty quickly after that, like several stocks did as well. And now taking a kind of a tumble. For the lifetime of the stock, it's up over 5,000%. So yeah, it's definitely had some growth for sure in certain areas. A little rough moment going on right now, but it's currently their price to earnings ratio, PE ratio, is around 18.67. Some people would consider that, somewhat undervalued. Sometimes people look at like 20 as being like okay, if you're under 20 PE, then you're looking undervalued. But of course, a lot of that depends on the company itself and its growth. Should you be looking at the PS, the price to sales ratio, if it's a growth company? Should you be looking elsewhere if it's, if it's a REIT, a real estate investment trust? You should PE, different calculations for things you want to look at for companies. So there's definitely other fundamentals and other financials you want to look at when examining whether or not you should buy a company and if it's undervalued. So it's trading near its 52-week low right there. You see the low company is currently trading at $64.78. 52-week low is going to be $62.24. So, and with Sysco being the number one food distributor in the United States, their current market cap is around $32.71 billion. And also with institutional investors, see last quarter is a little bit of a decline right there, around 1.98%, holding somewhat steady here though the past few quarters with the institutional investing. And so to go look back at their dividend history, you see how they've been increasing at 13 cents per share, 15 cents is quarterly, 17 cents per share, 19 cents, 22 cents. So a couple cents here and there, nothing like crazy, but definitely steady, sometimes a 1 cent, sometimes a couple cents, but they've been doing it for, at least that 50 years. So that's saying a lot right there. It just kind of been somewhat steady with it. Nothing like really shocking, like, wow, they went up, a ton of percent or anything like that. But they've been steadily, every now and then you have some outliers. For 2019, it was 39 cents, and then 2020, 45 cents. And they slowed down a little bit, but still raised it. And previously, the most recent raise was from 49 cents per share to 50 cents per share quarterly. But yeah, that is the first stock on this list I want to talk about is Sysco Corporation with their dividend yield currently around 3.08%. If you held this company, they typically have a payout date in January, April, July, and October. Now, the next company I want to talk about is Procter Gamble. Procter Gamble is a large consumer goods company. There is a good chance you have several products in your house right now that are under the Procter Gamble umbrella. Procter Gamble operates through 5 segments: beauty, grooming, healthcare, fabric and home care, and baby, feminine, and family care. Those are their 5 main segments right there, and they have several major brands under those segments for sure. They were founded in 1837 with a headquarters in Cincinnati, Ohio. And not that long ago, around a decade or so ago, they dropped several of their brands and started concentrating on their around, I believe, 60, 70 brands that were making like around 90-something% of their profits, of their revenue. So they're not just in it to just, hey, have a lot of brands. Like, hey, we got hundreds of brands. They will cut a brand, or do something with it, basically merge it with something, do something with it, basically, if it's not profitable, if it's not going towards their bottom line, and focus on their winners. Basically, they will cut their losers and focus on the winners, and they done that not that long ago. And with their brands right here for Procter & Gamble, you can see these brands, like I stated, there's a good chance you have some of these in your household right now. With baby care, you've got Love's, Pampers, All Good, and some others. Fabric care, you got Bounce, Downy, Tide, Gain. Family care, with their paper products, paper towels, toilet paper, Bounty, Charmin, Puffs. Feminine care, Always, Tampax, and others. Grooming products, Braun, Gillette, Gillette Venus, Art of Shaving, Aussie, Head and Shoulders, Old Spice, Pantene. Home care, Cascade, Dawn, Gain, Febreze. Mr. Clean, multi-brand programs, across they're global. So yeah, they're going to have brands across the world, basically, not just the United States for sure. They're all over. And oral care, Crest, Scope, Oral-B, personal health care, Align, Probiotic, Metamucil, Pepto-Bismol, Vicks, and yeah, a lot. You see some more. And some of their brands kind of cross over to different segments. So yeah, there is a lot of major brands under Procter & Gamble. And with Procter & Gamble, if you own this stock, they typically pay their dividend in February, May, August, and November. So that would be those next months. So filling up the calendar here, if you own Sysco and if you own Procter & Gamble, you see how you would be getting paid almost every month. And with the third stock I'm going to talk about, it's going to be every month you would be getting paid a dividend if you own all three of these stocks. So according to the history with Procter & Gamble, as you can see, that's their typical payout date. And the days look around the 15th, 14th, 17th, depending on what month it is. But the months are February, May, August, and November. Let's get into more details of their dividend here. And currently with Procter & Gamble, their dividend yield is around 2.57% with an annual payout of $3.76 and a quarterly payout of 94 cents per share. Their payout ratio is around 62.38%, which, is above 50%, but it's still not something that's like a red flag for me, considering how much revenue this company makes and profits. Their payout ratio, okay, they're definitely a profitable company, and they actually just recently announced earnings. I'll go over that a little bit, and they beat earning estimates. So yeah, payout ratios, not super red flag. Like I said, there's different. We'll look at some other payout ratios as well, but their 5-year growth rate for their dividend is 5.68%, and they've been growing their dividends for a consecutive 66 years, as stated right here. So yeah, way over that 50 years. They've surpassed that. I don't even know what's next. Is there something after being a dividend king, like a dividend universe? I don't know. But yeah, so yeah, Procter & Gamble, well over 50 years consecutively of dividend growth. That's just amazing right here. With their most recent dividend, they declared it on October 10th, 2023, with an ex-dividend date of October 19th, 2023, record date of October 20th, and payout date of November 15th for their upcoming dividend of 94 cents per share. So as of right now with this video, I'm recording it on I'm recording this video on October 18th. This would be pretty much the last day to buy this stock to get that payout of that current dividend on November 15th. And I'm hoping I get this video out today. I'm not saying rush and buy it today, because stock prices move around dividend dates as well. It's something to kind of notice. Some people trade off of dividends, basically like getting in at a certain day and getting out at a certain day and things like that. So yeah, there's multiple things that affect stock prices: macroeconomics, microeconomics, financials, guidance, news, dividends. So a lot of different things, but some people trade around that. For an ex-dividend date, you have to be in there at least the day before that to get paid that dividend that's announced for that same ex-dividend date. So that is what's upcoming now. If you bought the stock on the 19th or after the 19th of October, then you would not be eligible for that dividend that's going to pay out on November 15th. However, you would be eligible typically for that next dividend with Procter & Gamble is going to be, according to their history, paid out in February. And like I was stating, I wanted to talk a little bit about some of their other payout ratios. So with that standard payout ratio right there, the cash dividend payout ratio, you got 65.28%. If you're looking at the payout ratio according to the cash flow, that drops down to about 54.66%. So you see the payout ratios can kind of vary some depending on which method you're using to get that payout ratio. Varies a little bit with their payout ratio. Still not any kind of red flags I'm seeing with this. A company of this stature, Procter & Gamble, like typically a very safe company right here with dividends. So and with their dividend growth of Procter & Gamble, so yeah, you got the 3-year CAGR at 6.46%. That 5-year, we talked about that, 5.68%. 10-year dividend growth rate around 4.77%. So like single digit growth rate, nothing like crazy. I wouldn't consider this like a dividend growth stock. Somewhat, the dividend is growing, but I wouldn't like say it's a high dividend growth stock. It's a dividend growth stock, a stable, safe dividend stock with possibly some appreciation of the stock price as well, because we're going to talk about the stock price. And with the stock price of Procter & Gamble, you see the ups and downs right here. They're down about 1.52% for the year. So almost flat for the year, it looks like right there. And for 1 year, actually, if you go out just for a whole year, not just year to date, they're up about 16.27%. 3-year, the stock is up around 3.38%. 5-year, stock is up 69.9%. And lifetime of the stock is up over 4,000%. So this stock has had some moves right here down this year, but it's a steady pretty much stock with this price appreciation. Of course, it got hit with the COVID pandemic like a lot of stocks did. Right here you see in 2020, recovered quickly after that and stayed up nicely, dipped down some, but stayed up pretty much above the pre-pandemic levels right there. And this stock, Procter Gamble, is like a huge company, current market cap around $354 billion. And their PE ratio currently is around 24.80, at dividend yield around 2.57, 2.58%. And with institutional investors and Procter Gamble, as you see, it's pretty steady in the past year or so. It has a slight increase in this past quarter of 0.46%. But it's pretty steady where it's holding no major dips or increases. I mean, there's increases, a little dip, a little increase. So just holding steady somewhat with the institutional investing and Procter & Gamble. And Procter & Gamble recently announced earnings, and it looks like they topped earnings and sales estimates after hiking prices. Like I stated, companies of this magnitude with these huge revenues, with these huge brands, they somewhat have pricing power. They can cut costs in certain areas that smaller companies can't, and they can raise prices in certain areas that smaller companies can't, because they have the ability to, with the demand of their products, with the quality of their products. People look at these products and think like, oh, I'm buying, Gillette, I'm buying Tide, I'm buying quality. I'm not just, what is this? And they may pay a little bit more for it. They may not move to the store brand, the Walmart or the Target brand of something. They may stick with that even in environments of, economic, recessions or downfalls, or kind of, or maybe they will trade down in some areas, keep it the same in other areas, trade up in certain areas. But companies like this have pricing power. They can raise prices. And yeah, you may have some customers that say, okay, I'm noticing a price increase, I'm not gonna hold off. But you have other customers that will stay the same. They'll stick with it. And that kind of offsets the ones that maybe don't, or maybe they don't have that much movement in as far as customers that, say no to those prices and say yes to those prices. And then they just have a growth in the company because of the higher prices. So Procter & Gamble is definitely a company that has pricing power. Another company that's been doing that almost tried to make it on this list, but the way their payout date didn't really match up with the, get paid every month, is Pepsi. PepsiCo has been doing some price increases, and they have pricing power as well. That's another company with strong dividend. That's actually a Dividend King as well. So yeah, that's another company that makes me think of that when I think of Procter & Gamble, even though they're different segments somewhat, but consumer goods, consumer staples, things like that, with Pepsi, of course, being more food and beverage, but earnings breakdown of their recent earnings, as you see, they beat year over year, 6% from the previous year, with their net sales, organic sales growth, 7% versus that 5.83% estimate. And you see it breaking down in the segments. Beauty didn't do as well as the estimate, but grooming did better. Healthcare segment did better. Fabric, home care segment did better, as well as the baby, feminine, and family care. All their segments did better than the estimate, except for one. Operating profits were higher at $5.76 billion versus the estimate of $5.34 billion. With their earnings right there, nice earnings report. They popped up a little bit off of that in the pre-market, I believe. And let's see where they're trading at now, just as I'm recording this video for the day. And they're still staying up right there. So from the pre-market open right there, they're up around 1.91% right there as of this day with those earnings coming out. And previously, I think they rose up. Yeah, you see the pop right there. Boom. So they're still trading underneath. Let me see here. Yeah, underneath the 50-day moving average and right at that almost 200-day moving average, it looks like. So they could have that cross happening, but depending on where the charts go, we won't dive into that. Like I said, I just want to mainly talk about the company overall and the dividends. So we won't get into any chart technical analysis or anything right here, but that is where they're currently trading at with Procter & Gamble. This is not a company I own, but Procter & Gamble is a company I would consider owning if my portfolio wasn't already, I won't say it's heavy consumer goods because it's pretty diverse, but I do have like a large kind of, portion of some of my portfolio in consumer goods, including the next stock. That's one of the major top 5 stocks in my portfolio. I'll talk about that here soon. But yeah, so Procter & Gamble is one that is definitely on my radar. And I recently got into Johnson & Johnson. I kind of put those two companies somewhat side by side. I mean, even though Johnson & Johnson is more healthcare related, they do have those consumer goods, consumer staple products like Procter & Gamble. And I kind of put those side by side. I pretty much was like, okay, am I either going to buy Procter & Gamble here? I'm going to buy Johnson & Johnson here, because Johnson & Johnson is down for the year as well. And more so than Procter & Gamble. I'm just going to go over here real quick and show you something. So yeah, Johnson & Johnson is down around 13.53% for the year, way underneath their 50-day and 200-day moving average. So it came down between me personally with my portfolio, my goals. It's like, okay, I want to buy one of these stocks, Procter & Gamble or Johnson & Johnson. Which one is it going to be? And after my analysis and more research I did, it came down to me like, I'm going to go into Johnson & Johnson. So I recently started a position in Johnson & Johnson, and I'm happy with it. I'm definitely going to add to it for sure. It's not a major position, but I am adding to it. I actually bought a little more today. on this day right here on October 18th, and it's down for the day. Now, I like to add to stocks while they're down for sure. While they're beating up and down, I like to add to them. So that's the reason why I don't own Procter Gamble. It's not anything necessarily against Procter Gamble. It's just that I put it up against Johnson & Johnson for me personally, and Johnson & Johnson won that battle. That's not saying I would never get Procter Gamble. Like I say, it's still on my radar, still on my watch list for sure. And it definitely made this list when I was, making this list, composing 3 companies that you would get paid with monthly with a nice dividend that are Dividend Kings. And I didn't just pick 3 random companies. I looked at some things about the companies and the financials and the balance sheet, different things to say, okay, these are strong dividend paying companies, and Procter Gamble is definitely one of those. So yeah, that is the second company on the list, Procter Gamble. If you were to own this company, typically you would be getting paid a dividend in February, May, August, and November. And looking at their dividend growth, as you see, it's a few cents here and there, but not a lot of like 1 or 2 cents. Looks around like 4 cents there, 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 2 cents there, so 3 cents. So it ranges for sure. Their most recent dividend increase was from 0.9133 cents per share to 0.9407 cents per share. So that was their recent increase. They did that, I believe, earlier this year. So yeah, nice dividend increases over the years for sure. Strong dividend paying stock. That is Procter & Gamble with a current dividend yield of around 2.57%. And the next stock on the list right here is Target. First, before we jump into the dividend and the stock price, let's go over some information about Target. In case you're kind of unfamiliar, there's a good chance you've stepped foot into Target, you've bought something from a Target, either online or in the store or both, drive up, all that good stuff. So yeah, Target was founded in 1902 and is a major United States retailer. They have over 1,800 stores, and they offer, of course, general merchandise, clothing, home goods, food, and they have, typically a lot of them have CVS's within the building, Starbucks within the building as well. And I was in one the other day, they had Ulta Beauty inside of their store as well. It's almost like they're like a little mall themselves or something, like a little, you just go to Target, you can get, get your coffee or tea, get your prescription filled, get your beauty products, get something from your home, grocery shop. Very major company right there. Really neat how they pretty much mapped out their stores. And they had inventory issues. They're still battling those. They've had, like I said, kind of a rough year with retail theft. That's been a huge part. They've had a lot of theft going on in their store, and they've been taking a beating. But Target been around for a while. They are Dividend Kings, so they know how to navigate different economic environments and different things going on at their store, and to grow from it with their stock price appreciation and their dividend growth. So let's go over here to their dividend. And with Target, their payout date is typically going to be in March, June, September, and December. So as you see, that's what's been going on with them. Their payout date looks like it's always on the 10th. So yeah, according to their history of all the months, it's on the 10th. So they're keeping it pretty much the same across every month, it looks like. So yeah, with March, June, September, and December, payout days typically on the 10th of each month. And I haven't even noticed that. I own this stock. So yeah, full disclosure, this is the stock that I was talking about at the beginning of the video that I do own of these 3. And I've owned this stock for some years here, and I've sold out of it before for a profit, currently down in the position that I have in it. And I've been accumulating. I've been adding more to it. So not financial advice, but I have been around under $130. I've been accumulating, whereas under 130, around 130, and now it's around 110. I've been accumulating. It was down to 105, 106. I was accumulating. So yeah, I'm just adding on to this dollar cost averaging, bringing my average cost down. This is a stock I'm down in, but I'm bringing my average cost down. So yeah, their payout dates typically in those months. So right there, as you see, if you had all 3 of these stocks, you would be getting paid every month in the year with their historical payout dates. So with Target and their dividend, their current dividend yield is around 3.91%. with an annual payout of $4.40 per share. So it's going to be $1.10 per share quarterly, and they pay out quarterly like the other stocks in this video. And their payout ratio for Target is around 59.34%. And Target's 5-year growth rate of their dividend is 11.66%. And according to Seeking Alpha, dividend growth of 54 years consecutively. But sometimes you see kind of different years for this. So yeah, this article over here says 52 years dividend increases for Target right there. But they're over the 50 year. They are a Dividend King for sure. They recently raised it, not even this year with their stock being down. So let's look over to their history. Yeah, they recently raised their dividend from $1.08 a share to $1.10 per share. So with Target and their dividend dates, they recently declared their dividend on September 20th, 2023, with an ex-dividend date of November 14th, 2023, record date of November 15th, and a payout date of December 10th, 2023. So as of right now, if you were to get into this stock, like I said, not financial advice, if you were to get into this stock, you would be well before the ex-dividend date when this video is released. Depending on what date you see this video, though, that's a different thing. I'm hoping to get this video out here in October 18th, 19th, something like that. And with Target's dividend growth rate, it's impressive. It's double digits. Their CAGR 3 year is going to be 17.73%, 5 year at 11.66%, and 10 year of 11.14%. So double digit CAGR, compound annual growth rate of their dividends. This is nice for sure. They are definitely in that realm of dividend growth stocks, and they have some safety with their dividend, like I said, but recently they've definitely taken a hit. Let's look at the chart and the stock price for Target. So yeah, Target is a major company. Like I stated, market cap of $51.28 billion. So very large company. Currently their PE ratio is around 15.44. So they are looking at that undervalued amount according to some analysts for sure. Like I stated, I've been adding to it. Current dividend yield of around 3.91%. And for year to date, Target has taken a beating. They are down around 25%, as you see currently under their 50-day and 200-day moving average. For a whole year, down around 29.65%. For a 3-year chart, down 32.89%. Rough. So not just a rough year, they've rough past couple of years because of how low they've been going. And that decline is, they're in a downtrend for sure. So yeah, for a 5-year, looking much better. They're in the green, positive for around 35%. And lifetime of the stock, it's going to be over 3,000% right there for that. So, you know, they've definitely had some nice years, and they had a run up. I mean, that's a max chart. So it always looks kind of crazy because, you know, you have those first years. Sometimes it's like, oh, and then it's like, wow, what happened? But yeah, so they had some nice moments for sure. And of course, they got hit by COVID pandemic right there, and 2020 recovered quickly after that, above their pre-pandemic levels, stayed up there nicely. I mean, this stock was on a roar. It is down more than half than where it was up back in 2021. And part of 2022. And it's definitely an interesting stock that's taken a beating for multiple reasons. Some of their reasons they've taken a hit is their political, social stances and things like that. I won't get into that. This is not me saying like I approve or disapprove of that or anything. Let's look at some of the institutional investing. Pretty steady with some of that. You had a decline back in 2021, that quarter from the fourth quarter of 2021 to the first quarter of 2022. Had a decline. You have going back up most recently, down about 1.04%, but still pretty steady here in the past few quarters with their institutional investing. You did have some insider selling recently with this stock, including the CEO, Brian Cornell, sold around 30,000 shares back in August. And so that's something just to look at, because typically insiders, you know, they'll sell for multiple reasons. They sell, maybe they want a new home, new vacation home, new car, new this, something for their kids, different things like that. But typically with insider investors, they only buy for a few reasons. They think the stock is undervalued, think the company is undervalued, they think there's more growth in the company coming up, they see really great things, they're like, oh, this is trading too cheap. Or they want to show strength in the company. They want to show like, I think our stock price is too low. Look, I'm buying. I'm the CEO. I'm the CFO. I'm the vice president. All like that. So you have different reasons why insiders sell, more reasons why they sell, and only a couple of reasons why they typically buy. And those are stronger to me. When I see insiders selling, it's not like a panic, like unless you see a lot of it, then it's kind of like, okay, well, what's happening? But then if you see like an insider buying, that's the sign of strength right there. Haven't seen any of that recently. Of course, a lot of these insiders, they get grants. So they get, you know, positions thrown at them. So they get these grants and things like that, bonuses, considering how the stock's doing, how the company's doing, different things like that. So a lot of them don't have to buy. They have so many shares already. They're not going to buy because they got a ton. So some companies you won't see much insider buying because of that right there, the grants and the bonuses and things like that. But you will see the selling when it's like, hey, I've got a ton of stocks. I'm going to sell some. Like right here, you see Brian Cornell got granted over 100,000, around 100,000 shares. And he sold 30. The percentage that he sold, not much considering how much he has. So it's not really like a red flag, but it's still something just to consider when you're looking into investing in stocks. Target has several brands that generate over $1 billion in revenue. And that is just really impressive to me. That's just something that keeps standing out with me and Target in my position. One reason why I like to increase it, because not only are they selling like other companies, you know, Procter Gamble, for instance, they got their products in their stores, and Johnson & Johnson and several other major brands, but they also have their own private label brands that are generating impressive, you know, profits, impressive revenue. So that is something that's really neat right there, because you do have some people that may shift to those brands with their, you know, economic conditions going on. Oh, I'm not going to buy this major brand. I'm going to shift to, what is this brand from Target? And I personally have some Target brands I've bought, and it's like quality. It's not saying, oh, this is just a cheap brand. It's going to break. It's not good. It tastes good or things like that. So you have some people that'll do that, and that increases for Target. It's like they'll get you on different fronts. If you're feeling, you know, somewhat confident, or you're still buying your major brands that you like, whatever, you can buy them at Target. They're getting a piece of that. You're buying the private label Target brands. Oh, I'm going to try this brand that's a little bit cheaper. Target's getting a piece of that too. So it's like, it's definitely a way to diversify themselves in different economic environments. It's by having those major private label brands, but also selling those, you know, well-known major brands as well. Target brands. So yeah, they have, as you see right here, A New Day, All in Motion, Boots and Barkley, Bright Room, Clouds Island, Cat and Jack, Favorite Day, Everspring, Good and Gather, so in Goodfellow, Heyday, and Joy Lab, Kindfuls. So across different segments, Kindfuls, pet food, and you have Good and Gather, which is human food, and you have Everspring, cleaning products, and Favorite Day, food as well. And you got Cat and Jack, the children's clothing and apparel, and just very All in Motion, the athletic wear brand. So they are all over the place with their different brands, home products with Project 62 and Room Essentials and more. So they are diversified through their private label brands very nicely. I mean, that is very impressive right there. So that's one thing that really stands out with Target. One reason why I like owning this stock personally. With Target's growth of their dividend has been somewhat steady, but they are in that double digit range with their CAGR, their compound annual growth rate. As you see right here, just going back a few years, a couple cents here and there, 14 cents a share to 16 to 17, just 10 years ago, they're at 43 cents per share. And now they're at, $1.10 per share. So you see the growth right there. And sometimes it's a few cents, 9 cents there, 4 cents there, 4 cents there, 2 cents there. Most recently at 90 cents per share, 2021 and 2022, and then increased that to $1.08 per share. So 18 cents per share dividend growth quarterly. Right there, you see in 2022, and then in 2023, raised it just a couple cents. So you have a couple cents here and 9 cents there, double digit cents, so it's impressive dividend growth for sure. So with these major dividend paying stocks, these Dividend Kings, if you own all three of these, Sysco, Procter Gamble, and Target, you will be getting paid a dividend every month from the beginning of the year, January, all the way to December. Every month, you will be getting paid a dividend if you own all three of these stocks. So that is it with the video. Hope you all enjoyed it. Take care.